Good morning and welcome to the first episode of Before the Bell with Roman and Zane. I'm Roman, an economics student specializing in valuation and portfolio construction with a focus on disciplined long-term investment strategies.
And I'm Zane, a finance student and aspiring investment analyst who spends his time building models, reviewing earnings calls, and shaping raw data into actionable investment ideas. Before we get started, though, just a reminder that nothing we discuss is financial advice. This podcast is our way of sharing the process, how we think, how we challenge each other, and how we grow as students of the markets. So this is all to your own discretion. All right, there's the quick origin story. Then we'll just jump on into a big market move and a student focused playbook.
All right. Thank you, Zane. So, this idea started as a casual conversation between the two of us and quickly became a shared vision to create a daily podcast where we are able to cut through the market noise and focus on what truly matters within the market. Asset management appeals to me specifically because it combines technical precision with ethic responsibility, developing robust frameworks for evaluation, risk management, and allocation, while recognizing the impact that these decisions can have on real persons' wealth. This podcast is our own space to practice that discipline openly every single day.
That it is, Roman. That it is. And from my angle, as someone training to be an investment analyst, I'm here to translate accounting details and macro data points into questions that matter for valuation and positioning. What assumptions are baked into a price? Which data points move policy expectations? And where are the real information asymmetries? We'll always aim to explain technical terms the first time we use them so listeners who are learning can follow along easily.
All right, there's our origin story done. Now, let's pick a market move and unpack it in a way that actually helps you think about your certain portfolios.
Okay, so let's get into the market moves of the week, Roman, shall we? Markets are increasingly pricing in the possibility of policy rate cuts later this year if inflation continues to ease. Roman, give your high level read on that.
All right, thank you, Zane. At a high level, a signal of future rate cuts changes the discount to value future cash flows. Lower expected policy tend to reduce the discount rate, which mechanically boosts the present value of earnings expected in the future and can support higher equity multiples, particularly in sectors whose profits are weighted towards later years. For bond investors, usually push yields down and bond prices up, but the magnitude depends on what's priced into the curve already. Importantly, the reason for the cuts matters that much. Cuts because the inflation is sustainably under control are different from cuts because growth is stalling. And each case scenario has different implications for the signal exposures and credit risk.
Now I know that was a lot for anybody who was just maybe getting into investing in the stock market. So let me unpack that for you guys. Let's go with a more tactical lens for my analysis. First, markets are forward looking and express a probability distribution about future policy. When traders move from, say, a 10% chance of cuts to a 40% chance, that reprices assets even if no actual cuts occurs yet. Second, let's look at the yield curve and the long-term premium. If long-term yields fall more than short-term yields, that flattens or steepens the curve in ways that change how you hedge duration or position spread exposure. Third, an analyst should run scenarios and they analyze what happens to your DCF if the discount rate is 50 basis points. Lower, how sensitive is your intrinsic value to rate moves? Fourth, sector positioning. Financials can underperform on rate cuts because net interest margins compress, while growthier sectors with long term duration cash flows, like certain software firms, can benefit. Fifth, timing and sequencing matter. If cuts are priced and then reversed because data reaccelerates, the quick rotation can punish momentum chasers. So the practical analyst moves are: A, quantify sensitivity via stress tests; B, check portfolio duration and interest rate hedges; and C, maintain optionality, small stage changes rather than a full flip.
Thank you, Zane. So, for investors, it's important to not interpret whether the Fed signals as a binary buy or sell decision. A more disciplined approach would be to plan in advance how you would adjust exposure. For example, establish clear rules when to extend duration by a set percentage or when to reduce weigh-ins in cyclical sectors. Then, backtest those rules in a spreadsheet like an Excel spreadsheet or a Google Sheets so your decisions are grounded in process rather than emotion.
As a very important emotion will take a lot of people out the game early. So, in translation, model the effects, size moves as a process, and keep a checklist so headlines don't force you into bad decisions.
All right. Thank you, Zane. Macro context is covered now, but since we are students ourselves, instead of having a traditional career within the segments, we're going to include a student playbook, including some practical steps for developing skills, the mindset, and the habits that make someone stand out as an analyst or hopefully a future asset manager.
And as you said, Roman, we are both students. So this segment is practical and intentionally small step. What you can do this semester to actually build skills and a portfolio.
All right. Let's think of a student playbook as three non-negotiables that you commit to every single week, something that compounds over time if you stick with it and follow along down the route. First, I would say you could write short notes, maybe paragraphs, about 300 to 400 words on either a company or a macro growing theme. In that note, force yourself to answer three questions. What are the following narratives within the company? Why does it matter at this current time? And what are some key numbers that actually drive up the story? And what's the bullish or bearish case with at least two reasons on each side, why and how? By the end of the semester, you have more than a dozen or more write-ups, which could double as work samples you use in interviews instead of just saying that you're interested within the markets. Second, take those ideas and practice putting numbers behind them with a simple modeling drill. You could begin small by breaking revenue into unit times price, and then you can move on to stress test margins by asking what happens if costs rise or expenses fall. Try building a basic discounted cash flow. If you can build a DCF yourself, then go along with it. If not, you can follow someone on YouTube. The point isn't to create a perfect model, it's to create the habit of quantifying your assumptions and to see how sensitive valuations are to small changes in growth or discount rates. Over time, this practice moves you from toy examples to deeper analysis that you could actually use within your interviews. And third and finally, you should reach out to at least one professional each week, someone who you should share full insights online. Instead of sending vague messages about reach out about your career, make sure that it's very specific and concise. Ask if someone will speak to you for about 15 minutes or so and critiquing your pitch, or whether you could write them a short write-up and get certain feedback to improve yourself. That shift shows respect for their time and gives them something to concrete to respond to, which makes their advice actionable instead of being generic. If you keep this cadence for about 12 or so weeks, you'll have a main portfolio of your critical thinking, stronger modeling, and 10 or more contracts who have already seen your work. That's the difference between talking about finance and being ready for finance. Over time, these small steps compound into a portfolio of real work that you can show your recruiters, and they build your judgment skills far faster than passive reading.
As far as a few tactical tips, join or start an investment club and actually run a mock portfolio, even 10K hypothetical. Record decisions and outcomes weekly and trade small position sizes if you want skin in the game, but only after you've written the thesis. Use your school resources for interview prep, mock calls, and resume reviews. And use version control for your work, a dated folder structure, so you can show progress. Let's say it's like this. Here's my note from September. Here's my revised note from November after feedback. That narrative of improvement is gold to recruiters.
I agree, Zane. I agree. So there's our student playbook done. Now, for a fun way to end the episode, so listeners can feel like they get to know us better and we get to know each other better.
All right, Roman. So I have a question for you. What would be your favorite finance book currently and why?
So I actually major in economics, but the book that I'm currently reading called The Instant Economist by Timothy Taylor, I really like how it makes complex economic ideas clear, concise, and practical, which helps me think about the markets and investing in a grounded way. And yourself, Zane?
Thank you for asking. I actually have been really enjoying security analysis. This gave me scaffolding for valuation rigor and thinking. Fast and slow explains why smart investors still make avoidable errors.
All right. Thank you, Zane. What do you think is a very underrated skill for analysis or someone who's attempting to be an analysis?
Honestly, I'd say it's the ability to ask disciplined questions, the kind that cut past the noise and surface the real drivers behind the story. Because I feel like a lot of people, they ask basic questions, and whoever you're asking, they might get asked that 1,000 times a day. So you're not really standing out. So that's often how you find true edges in your analysis, by asking the right questions. What about you, Roman? What do you see as a skill that doesn't get enough attention?
I agree with you that certain times you just need deeper questions. But for me, I would feel as it's emotional calibration. Knowing that when to sit on a conviction versus when to be humble and adjust your view based on new information, I feel like that's very critical within our economy right now. It's one thing to model a company perfect, but it's another to manage yourself so you don't get trapped by the overconfidence and the short term noise.
I really agree with that. Having overconfidence in your abilities and your knowledge, it takes a lot of people out the game. It makes them just make dumb decisions with their money overall. What about you? What do you think is the biggest mistake you've learned from?
I believe for me, it's over trading. Early on, I was confused with the constant activity with an actual edge. I often thought that making more trades somehow meant that I was more engaged within the market or that I was more informed. Lesson wasn't just about reducing transaction costs, it was realizing that patience within the market and selective focus often produces better results than constant action.
I really agree with that. That resonates with me. I run into something similar, not exactly the same, but for me, it was just not documenting the reason behind my trades or my analysis. Without notes, it's almost impossible to truly learn from past choices because you forget why you made them in the first place.
I agree. I agree. Ian, what's a one productivity habit that you have within your life?
I would say my go-to is a whiteboard session. I'll write out ideas, models, or concepts, then step back and reflect on them visually. I really love having stuff on my whiteboard because as soon as I get out the day, I know what I want to accomplish. I love having goals written down. Seeing things laid out helps me connect dots and spot gaps I might miss in notes or on a screen. It's kind of a thinking out loud, but it's more tangible. What about you? What would be a very good productivity habit you think a lot of people don't do, but you see makes an improvement in your life?
Yeah, so for me, it would be a nightly micro review. Every evening, I try to reflect on 3 wins from throughout the day and define 2 priorities for the next day. It's a small habit, but it forces people like myself to focus and help track progress over time instead of just reacting to whatever feels urgent.
Yeah, definitely. I would say having a review just keeps you in check and brings you back down to earth level. Um, a
Most
question I would
definitely,
have
most
for
definitely.
you would be if you were allocating a hypothetical $100,000 today, how would you think about it at a high level?
Yeah, so if it were me, I'm more of an aggressive better that is. So I would lean towards deeper, higher conviction investments. By us being young, I can afford to take on more risk. So I'll allocate a larger portion to a concentrated ideas where I've done the research myself with models with the goal of building skills and potentially outsized returns over time. I'll still keep some of the cash for flexibility and small allocation to learning abilities, that is. But my focus would be largely on putting capital behind the positions that I truly understand and believe in long term.
That makes sense, and it reflects a longer term horizon. I would say my approach would be more structured. I understand that I'm young. I am more in the mindset of let me just set myself up in the future first, and then I'll get into the riskier stuff. So I would say I'd keep around $5,000 in liquid cash just for flexibility. I have 65,000 in diversified long-term investments for steady growth, such as the S&P 500, VOO, Vanguard.
Mhm.
I would have 10,000 in higher conviction or riskier ideas. So this is, the individual stocks, the crypto. I would have 15K in that around, and then I would have 5K towards personal development, like courses, learning from others, because you have to pick through. Some of them may be good, some of them not, but I feel like the ones that truly provide value, they're worth the money. So it's just a question about how concentrated or how diversified you want your exposure to be at this stage.
All right. Thank you, Zane. So that should give our listeners a sense of how we think and where we could differ. So, time to wrap it up. Once again, thank you guys for tuning in to the first episode of Before the Bell with Roman and Zane, getting to know us a little bit. We really appreciate your time to listen, and we hope that you found value in our discussions for today. If you enjoyed the show, please subscribe, leave a rating, and share with your friends who are interested in learning about the markets and investing alongside us. We also love to hear from you. Send us a headline or student question or any question that you have about us. If you want us to break it down, we will probably feature it within the podcast. And we'll feature at least one listener submission each and every week. Don't forget to follow us on TikTok and Instagram at Before the Bell, Roman Zane, to catch updates, clips, and extra insights from the show.
And a quick final reminder for everybody, nothing here is financial advice. We are learning out loud. Until next time, keep writing short notes, running small modeling drills, and paying attention to the week ahead from key macroeconomic updates. NVIDIA earnings to Labor Day at the end of the week and other market moving events. Have a wonderful day, and we'll see you before the bell.